psychology of the stock market. How to make smarter decisions. The role of emotions in investing. How to overcome fear and greed. Investing can be a daunting task, especially for those who are new to the process. It is easy to become overwhelmed by the sheer numbers of options available and potential for financial loss. However, it is important to remember that emotions can play a major role in the success or failure of an investment. Fear and greed are two of the most common emotions that can influence an investor's decision, and it is important to understand how to manage these emotions in order to make sound investments. Fear is a natural emotion that can be triggered by the potential for financial loss. It can cause investors to become overly cautious and avoid taking risks, even when the potential rewards are high. This can lead to missed opportunities and lack of diversification in an investment portfolio. Fear is a natural emotion that can be triggered by the potential for financial loss. It can cause investors to become overly cautious and avoid taking risks, even when the potential reward is high. Fear is a natural emotion that can be triggered by the potential for financial loss. It can cause investors to become overly cautious and avoid taking risks, even when the potential rewards are high. This can lead to missed opportunities and lack of diversification in an investment portfolio. To overcome fear, investors should focus on the long-term potential of their investments and take a more measured approach to risk. They should also remember that losses are a part of investing and that it is important to accept them as part of the process. Greed is another emotion that can influence an investor's decision. Greed can cause investors to take on too much risk in pursuit of quick profits. This can lead to impulsive decisions and lack of research into potential investments. To overcome greed, investors should focus on the fundamental of an investment and take a more disciplined approach to investing. Greed is another emotion that can influence an investor's decision. Greed can cause investors to take on too much risk in pursuit of quick profits. This can lead to impulsive decisions and a lack of research into potential investments. To overcome greed, investors should focus on the fundamentals of an investment and take a more disciplined approach to investing. They should also remember that there is no such thing as a sure thing and that it is important to diversify their investments in order to reduce risk. By understanding the role of emotions in investing and taking steps to manage them, investors can make sound decisions and increase their chances of success. Fear and greed can be powerful emotions, but with the right approach, they can be managed and used to the investor's advantage. Investment decisions are often influenced by cognitive biases, which are mental shortcuts that lead to irrational decisions. These biases have a significant impact on the success of an investment, as they can lead to decisions that are not based on sound financial principles. This documentary will analyze the impact of cognitive biases on investment decisions and discuss how investors can mitigate the effects of these biases. For example, the availability heuristic can lead to investors to overestimating the likelihood of a certain outcome, while the confirmation bias can lead them to seek out information that confirms their existing belief. Additionally, the anchoring bias can lead investors to rely too heavily on initial information when making decisions, and the status quo bias can lead them to stick with existing investments even when better options are available. These biases can have a significant impact on the success of an investment. The confirmation bias can lead investors to seek out information that confirms their existing beliefs, leading them to make decisions that are not based on objective evidence. The anchoring bias can lead investors to rely too heavily on initial information when making decisions, and the status quo bias can lead them to stick with existing investments even when better options are available. Additionally, investors can seek out objective advice from financial professionals. Fortunately, there are steps that investors can take to mitigate the effects of cognitive biases on their investment decisions. For example, investors can use a variety of tools to help them make more informed decisions, such as financial calculators and portfolio analysis software. Additionally, investors can seek out objective advice from financial professionals and can use a variety of strategies to help them make more rational decisions, such as diversifying their investments and setting realistic goals. In conclusion, cognitive biases can have a significant impact on investment decisions, leading to decisions that are not based on sound financial principles. Fortunately, there are steps that investors can take to mitigate the effects of these biases, such as using a financial calculator and portfolio analysis software, seeking out objective advice from professionals, and diversifying their portfolio. Taking these steps, investors can ensure that their investment decisions are based on sound financial principles. Loss aversion is a psychological phenomenon that has been studied extensively in the field of behavior economics. It refers to the tendency of people to strongly prefer avoiding losses to acquiring gains. The phenomenon has been found to have a significant impact on decision making and can lead to poor decisions if not taken into account. In this documentary, we will discuss the psychology of loss aversion and how to avoid making poor decisions due to it. First, it is important to understand the concept of loss aversion. Loss aversion is the idea that people are more motivated to avoid losses than to acquire gains. This means that people are likely to take action to avoid potential loss than to pursue a potential gain. This phenomenon has been found to be particularly strong when the potential losses are large relative to the potential gains. It is important to understand how loss aversion can lead to poor decisions. Loss aversion can lead to decisions that are overly conservative and risk aversion. People may be unwilling to take risks that could potentially lead to gain because they are more focused on avoiding losses. This can lead to missed opportunities and suboptimal outcomes. Finally, it is important to understand how to avoid making poor decisions due to loss aversion. The key is to recognize when loss aversion is influencing your decision making and to take a step to counteract it. One way to do this is to focus on the potential gains of a decision rather than the potential losses. This can help you shift your focus away from fear of loss and towards the potential reward of taking a risk. Additionally, it can be helpful to consider the long-term implications of a decision rather than the short-term ones. This can help to reduce the impact of loss aversion and lead to more rational decision making. Loss aversion is a powerful psychological phenomenon that can lead to poor decisions if not taken into account. By understanding the psychology of loss aversion and taking steps to counteract it, you can avoid making poor decisions due to it. One of the most important concepts in behavioral finance is the concept of anchoring. Anchoring occurs when an investor's decisions are influenced by a reference point, such as a previous price or a benchmark. For example, if an investor sees a stock that has recently gone up in price, they may be more likely to buy it, even if the current price is not necessarily a good value. By understanding the concept of anchoring, investors can avoid making decisions based on past prices and instead focus on the current fundamentals of the stock. Another important concept in behavioral finance is loss aversion. Loss aversion occurs when investors are more likely to take risks to avoid losses than to make gains. And remember, another important concept in behavioral finance is loss aversion. Loss aversion occurs when investors are more likely to take risks to avoid losing than to make gains. This can lead to investors holding onto losing investments for a long term or taking on too much risk in an effort to make up for losses. By understanding loss aversion, investors can make more informed decisions about when to take risks and when to cut their losses. Finally, behavioral finances also emphasizes the importance of mental accounting. Mental accounting is the process of categorizing investments into different buckets, such as long-term investments, short-term investments, and speculative investments. By understanding the concepts of anchoring, loss aversion, and mental accounting, investors can make more informed decisions about where they put their money and when to take risks. By using behavioral finance to their advantage, investors can maximize their return and minimize their risk. Diversification is a key strategy for reducing risk and maximizing returns in an investment portfolio. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce their exposure to any single market or sector and reduce the overall risk of their portfolio. Diversification can also help investors maximize returns by taking advantage of different market cycles and opportunities. The most basic form of diversification is to spread investments across different asset classes. This means investing in stocks, bonds, and cash, as well as alternative investments such as real estate, commodities, and private equity. By diversifying across asset classes, investors can reduce their exposure to any single asset class and reduce the overall risk of their portfolio. Another way to diversify is to spread investments across different sectors. This means investing in different industries such as technology, healthcare, and energy. By diversifying across sectors, investors can reduce their exposure to any single sector to reduce the overall risk of their portfolio. Finally, investors can diversify by investing in different geographic regions. This means investing in different countries. By diversifying across geographic regions, investors can reduce their exposure to any single region and reduce the overall risk of their portfolio. By diversifying across asset classes, sectors, and geographic regions, investors can reduce their exposure to any potential single market or sector and reduce the overall risk of their portfolio. At the same time, diversification can help investors maximize return by taking advantage of a different market cycle and opportunity. By spreading investments across different asset classes, sectors, and geographic regions, investors can reduce their risk and maximize their returns. The impact of the market sentiment on investment decisions is a complex and multifaceted issue. Market sentiment is a term used to describe the collective attitude of investors towards a particular security or market. It is often used to gauge the overall sentiment of the market and can be used to inform investment decisions. Market sentiment can be influenced by a variety of factors, including economic news, political events, and investor psychology. For example, a positive economic report can lead to increased investor confidence, which can lead to an increased buying activity and higher stock prices. Conversely, a negative economic report may lead to decreased investor confidence, which could lead to decreased buying activity and lower stock prices. Investors should use market sentiment as one of many tools to inform their investment decisions rather than relying solely on it. In addition, investors should be aware of the potential risks associated with investing based on market sentiment. Investors should be aware of potential risks associated with investing based on market sentiment. For example, if the market sentiment is overly optimistic, investors may be more likely to invest in risky assets, which can lead to losses if the market turns against them. Similarly, if the market sentiment is very pessimistic, investors may be more likely to avoid investing in certain assets, which can lead to missed opportunities if the market turns in their favor. Overall, the impact of market sentiment in investment decisions is an important consideration for investors. Market sentiment can provide valuable insight into the overall direction of the market, but it should not be relied upon as the sole source of information. Investors should use market sentiment as one of many tools to inform their investment decisions, while also being aware of the potential risks associated with investing based on market sentiment. The role of risk tolerance in investing. How to determine your risk profile. By taking a long-term approach to investing, investors can benefit from the power of compounding, which is the ability of an investment to generate returns that are greater than the sum of its parts. Investing with a long-term perspective can be a great way to maximize returns and minimize risk. By taking a long-term approach to investing, investors can benefit from the power of compounding, which is the ability of an investment to generate returns that are greater than the sum of its parts. This is because the returns from an investment are reinvested, allowing them to generate additional returns over time. Additionally, long-term investments can help investors to avoid the pitfalls of short-term market volatility, as well as the costs associated with frequent trading. The power of compounding is one of the most powerful benefits of a long-term investment. By reinvesting returns, investors can generate returns that are greater than the sum of their initial investment. This is because the returns of an investment are reinvested, allowing them to generate additional returns over time. This is especially beneficial for investors who are investing for retirement, as the power of compounding can help to generate a larger nest egg over time. Long-term investing can also help investors to avoid the pitfalls of short-term market volatility. By investing for the long term, investors can avoid the risk of short-term market fluctuation, which can be unpredictable and difficult to predict. Additionally, long-term investing can help investors to avoid the costs associated with frequent trading, such as brokerage fees and taxes. Long-term investing can help investors to take advantage of the power of dollar cost averaging. This is a strategy in which investors invest a fixed amount of money in a particular asset on a regular basis. By doing this, investors can take advantage of market fluctuation and purchase more shares when prices are low and fewer shares when prices are high. This can help to reduce the overall risk of an investment portfolio, as well as maximize returns over time. In conclusion, investing with a long-term perspective can be a great way to maximize returns and minimize risk. The role of patience in investing. Patience is an essential quality for any investor, and it helps to ensure that decisions are made with a clear head and a long-term perspective. Impulsive decisions can lead to costly mistakes and can even derail an entire investment strategy. To avoid making impulsive decisions, investors should take the time to research their investments, understand the risk involved, and develop a plan for how to manage their investments over time. First and foremost, investors should take the time to research their investments thoroughly. This means understanding the fundamental of the company or asset they are investing in, as well as the broader economic and market conditions that could affect the performance of their investments. Taking the time to research investments can help investors make more informed decisions and avoid making impulsive decisions based on incomplete information. Investors should understand the risk associated with their investments. This means understanding the potential for losses as well as the potential for gains. Knowing the risk associated with an investment can help investors make more informed decisions and avoid making impulsive decisions based on unrealistic expectations. Finally, investors should develop a plan for how to manage their investments over time. This means setting goals for when to buy and sell, as well as how much to invest in each asset. Having a plan in place can help investors stay disciplined and avoid making impulsive decisions based on short-term market fluctuations. In summary, patience is an essential quality for any investor. Taking the time to research investments, understanding the risk involved, and develop a plan for how to manage investments over time can help investors avoid making impulsive decisions and ensure their investments are managed with a long-term perspective. These emotions can lead to irrational behavior, which can have a big impact on the market. For example, when fear is running high, investors may sell their stocks in a panic. This can lead to a sharp decline in prices. On the other hand, when optimism is high, investors may buy stock without doing their due diligence. This can lead to a bubble. The psychology of the stock market is a fascinating and complex subject. By understanding the way the emotions affect investor behavior, we can better understand how the market works and make more informed investment decisions. In conclusion, the psychology of the stock market is a complex and fascinating subject. By understanding the way that emotions affect investor behavior, we can better understand how the market works and make more informed investment decisions. By understanding the psychology of the stock market, we can make better investment decisions and increase our chances of success. I'm your host, Gerald Clyde II. Until next time.